Welcome to The Buy-In. My name is Trent Cripps, Director of Property Strategy at Sevenfold Property Group, and I'm also a long-time avid property investor myself. My co-host, Simon Podger, is Director of Lending for our sister company, Your Future Strategy. Please note, all the opinions and information in this podcast are of general nature only and should not be relied upon as advice. You should always seek professional guidance at all times before making any investment decisions. Please see the link at the bottom of each episode. Okay, welcome back, Gareth Croy from Your Future Strategy.
Yeah, welcome back. Good to be back.
Part 2 of self-managed super funds. There's so much to talk about. We couldn't cover that all off in one episode, and we're probably not going to cover it all off in this episode either.
No, lots of detail.
Gareth, I'm really keen to understand or get into the detail of why people invest in property, specifically inside a self-managed super fund, because I think from a lot of people that I've spoken to or that set up self-managed super funds, I think the appeal and the vast majority of them are investing in property. What's your take on why that is the case?
Well, let's start with why you'd invest in property, full stop. So as an asset class, people are comfortable borrowing for bricks and mortar. And so more so typically than a higher growth strategy like borrowing to invest in shares. And in real simple terms, and I'll make the numbers easy, if you purchase a property for $1 million in a market that's going up by 7%, so buy it for $1 million, 12 months later it's worth $1,070,000. If you borrow 80%, so $800,000, and you put $200,000 of your own cash in, then you've achieved a $70,000 return off $200,000 of your own money, which is a 35% return. So really compelling. So in the same way that's attractive to somebody in their own names outside of super, of course, it's incredibly attractive return for a self-managed super fund as well. Where it's, I guess, why it's attractive to people for superannuation is that in that scenario where you're creating this extra $70,000 worth of value, it's what we call growth. And that growth, if we accumulate that through your working career, we then sell the asset once you've retired. That capital gain is then tax-free. So as an asset class that typically is focused on growth as opposed to income being the rent, which generally services the holding costs, being interest and building insurance, etc., the real value is in the accumulated growth over time. So the superannuation structure being what it is, creating that wealth through growth, property lends itself really nicely to superannuation.
Absolutely. You don't need to tell me that twice. I love my property. And look, I always say to people, the real wealth in property is the long-term compounding growth. So with self-managed super funds, it's very much about creating wealth for retirement and your post-working life. So there, when I talk to some people that have thoughts about investing in property inside a self-managed super fund, some are very cash flow focused. Now, of course, that's important to your investments because we don't want to be having to contribute too much into it to hold it. But I guess the thing with a self-managed super fund is it's not all about the property. We also want to have that diversification. So we kind of want that property to take care of itself, but talk us about really where you want to place people in terms of diversification as well.
Yeah, so it's important that you're not putting all your eggs in one basket. So the diversification conversation is around, having enough or putting a deposit into a property, but then having enough cash or left over to invest into other asset classes. So that way you're still achieving some performance from these other asset classes, which often aren't correlated. So when something's happening in one asset class doesn't mean it's performing within the other asset classes. So combined, they also, if they're not correlated, can actually reduce the overall volatility of your fund. So if you're looking at the total balance as opposed to single asset, it smooths the ride a little bit.
Yeah.
And I'm just going to say, and coming back to that other podcast we did as well, was you talked about the liquidity has to be considered and stuff like that. And obviously having all your all eggs in one basket also poses another problem,
That's
because liquidity property is totally different to shares and stuff like that.
Yeah, so the last thing you want is to be able to is requiring to sell the property because something's happened and all you've got is a little bit of cash. So you want that flexibility. Unfortunately, inside self-managed super funds, if you have a loan, and we can talk about limited recourse borrowing arrangements, it's the technical structure you're required to borrow inside super. It doesn't allow you to increase the loan. So if something happens, you can't top up the loan to access some cash inside super. So you need to be able to have enough resources outside of just that property to supplement, what you're investing in.
So let's get back to the property itself. There are certain rules about what you can invest in property-wise. For example, can you build? Can you develop property? Or what are some of the rules and things to consider in that space?
Yeah, so there's some rules and principles here, and so whether answering things like can you build or not isn't so much whether you could build, it's how those contracts are structured. So you can achieve that result, but you can't do it in some ways. So what they call a two-part contract you can't do. It needs to be on a single contract. So, and the reason for that is that the legislation doesn't allow you to improve the property whilst you've got a loan in place. And so if you acquire a block of land, for example, building on that block of land would be considered an improvement. In the same way that if you purchased that block of land and you wanted to subdivide it, that would also be improving it. So you're restricted from doing improvements to property whilst there's a loan in place. So what most people don't know is that if you owned that block of land and you had no debt on it, then you could subdivide it. In the same way, you could buy a block of land with no debt and build on it. But without the gearing, it doesn't become as an attractive performance. And so that's why most people don't know that, because it's not really a strategy that works. There's better alternatives. You are allowed to maintain and repair the property, so keep it to the same standard. You can renovate a property, and this is sort of an area that isn't well explained, is that you can't use borrowed money to renovate the property. You can acquire the property, but you'd need to use cash from within the fund to renovate it. So you'd need to make sure you've, within your strategy, budgeted sufficient capital to do that renovation if that's the track you're going down. The rules really relate around what you can and can't do with borrowed funds.
Okay, absolutely.
Yeah, and I was just going to tack on there. It's interesting, that people sort of get, people that are interested in property usually sometimes open an SMSF with property sort of thing, inside and outside, and they sort of cross over a bit on what you can and can't do.
Yeah.
And then speaking about renovating, you hear sometimes hopefully it gets cut off at the pass, but I'll renovate this SMSF, it's got a loan, and then I'll cash out the equity and then do my next one and stuff like that. And it's like, well, you should go speak to your financial planner about that, but that's a pretty big no-no sort of thing. So.
Yeah, and that's, I guess, where people have seen the opportunity to create value, but as they create the value, they want to access that equity. And so outside of super, you're very welcome to refinance, access that equity, and quite often go and do another property with it. Inside self-managed super funds, with these arrangements around borrowing, you can't increase the loan. You can refinance it, so if it's not competitive, along with reasonable costs. But so if you took a renovation strategy inside a self-managed super fund, you might force some value and push the value on completion. And the temptation would be to go, okay, well let's take that uplift and go and do it again. The only way really to do that is to sell the property, realise the gain, and take that equity and go and do it somewhere else. You just have to factor in that there's capital gains tax to be paid in the process.
Some of the other rules around property, if you own a property or if you've invested in a property inside a self-managed super fund, and you want to put little Johnny, who's your son, who's going to university, into that property, or you want to put your cousin or someone in there, can you do that?
Short answer, no. If we come back to the comments from last week around the sole purpose test, which is to provide for retirement benefits of the members of the super fund, helping out your child or your nephew, niece, whoever the related party is not consistent with providing retirement benefits for the members of the fund. And so, you cannot, rent or have a related party occupying the property, but B, you also can't acquire property from them either. So it's all designed to be arm's length transactions so that there is, at all times, effectively commercially, arm's length, so that there is no benefit to someone, and it's all focused on providing for the self-managed super fund.
And I was kind of mentioned on that as well, is a lot of people I think got caught about buying high-rise apartments and stuff like that in holiday let, where they had the 2 weeks free in Christmas or anything like that. But that definitely includes that as well. You can't.
Correct. So you can't use the property for your own benefit. The exception to that is where it's what we call commercial real property. So if you acquire a property for your business to use, but you have to lease that on a commercial basis. So you have to prove that it's at market rent. So you can't acquire it for your own personal use.
I don't think we've even mentioned this, but you can't you can't do it as an owner occupier. Let's cross that out as well as a.
No, again, coming back to why we're doing it, it's to generate results that then help you to fund your retirement.
So just because you invest in a property inside a self-managed super fund, and let's say you do have a 15, 20-year runway before retirement, do you have to hold on to the property for the entire duration, or do you have the ability to sell it before retirement?
Yeah, so everyone's strategy is different. You can hold the property right through, so effectively you don't sell it until retirement. But if you're 20, 25 years until retirement, it's unlikely that a market's going to continue with the growth through that whole period. And there'll be other pockets within the Australian property market that might make more sense. And so it really, at that point, needs some evaluation with a professional advisor around what's the tax CGT that you would pay, and evaluate, even if we take up the CGT, it makes more sense because of the gains I can get in a different market. So at that point, then you would consider selling it, because you even paying the capital gains tax, you're going to be better off with a higher fund balance in retirement.
Okay, well, let's move into how the lending works for a self-managed super fund property. And I've got two very well-experienced experts in this space, with both Simon and Gareth here. So really, what's the process with the borrowing side of investing in property?
Yeah, I suppose so. Once the SMSF has been established, at that time as well, we find a property, they'll get the property entity created, like the deeds and the trustee for that sort of arranged. Contracts, according to Lisa, in the correct names we've spoken to on another podcast, and that's all correctly done in the property side entity. From the loan front, the loan is put into the SMSF, and the property's in the property side. So sort of when you're doing contracts and things like that, for the rental markets and things, you've got to just keep that in the back of your mind. In terms of the assessment, you're looking at the contributions coming in from the members. the rent from the new property, and then versus the expenses, so the loan repayments, any pension, and the tax considerations there. Now, if that sort of works, the serviceability, comes into play, sort of thing, then the lender will provide you X amount of in terms of a loan. I suppose the difference between a normal loan and the SMSF is coming back to who the lender is lending to. It's the SMSF, and it's the most important thing is there. It's a limited recourse borrowing arrangement, and the key factor in that is that if the lender then has to enforce its mortgage and take back the property, that it's only able to then take the property as security. The other assets in the super fund are quarantined, I suppose is what I'm trying to say there, sort of thing. So your other shares and ETFs and cash and stuff like that, they can't get a hold of, sort of thing. The only thing though is that with generally most lenders now will require a personal guarantee, so you do have to just keep that in the back of the mind, sort of thing. So while the lender can't take access of the SMSF, outside the property, they can then pursue you personally after that, sort of thing. So that could be whatever assets you own personally because of that personal guarantee in there. So most times when you're getting one of these limited recourse borrowing arrangements, you do have to get independent legal advice, sit down with a solicitor to try and understand what the obligations that you are actually signing there, sort of thing. And I suppose it comes back because clients do get a bit confused because there's so many entities involved and their name is in wrapped up on all those entities in terms of being the director and things of that nature, that you do have to, I think you mentioned about having different hats on, that you do have to remember, what am I actually signing on behalf of? Okay, I'm signing as the SMSF trustee, sort of thing, as the director there. Now I'm signing as a personal guarantee on that capacity. So.
Yeah, and I think it's important to understand from a legal perspective this limited recourse borrowing arrangement. It's got all sorts of jargon, and some people call it a bear trust, some people call it a property trust. It's all the same thing. And what it is effectively a trust that sits underneath the super fund. As Simon said, it's got this this quarantine effect that holds that security away from the rest of your assets whilst there's a loan in place. And it's sort of interesting to know that if you did get to the end of your loan, that the asset, when there is no borrowing arrangement left, vests back into the super fund, and the actual trust itself no longer exists. So if not many people get to the end of their loans, but if you did, that's what would happen.
I haven't seen it, but and just on that, so when we're coming back to it, on the title is the property or the bear trustee entity, sort of thing. So in that, there's I suppose some transfer forms which happen for them to come back for the SMS to own it, sort of thing. Yeah. But then that's stamp duty exempt, I'm thinking, or something like that.
Yeah, well, it is. So effectively, it's a transfer from the trust because it's no longer required, and there's no transfer duty on that.
Interesting. And Simon or Gareth, whoever wants to answer it, really, is there any maximum borrowing limits for a property inside a self-managed super fund?
Yeah, I mean, each lender's different with their criteria, but again, it comes down to the serviceability, the amount of members, what the contributions are. That's what the assessment will be looking at there, sort of thing. So the security being offered as well, as it residential, commercial, what's being offered, the location and things of that nature. So
I think, if we speak really technically, we think often about mainstream lenders of self-managed super funds, but at a technical level, as long as it's on commercial basis, you can borrow from anywhere. Yeah. And so there are no limits. However, if we go back to the obligations of the trustee needs to be satisfied that they're doing the right thing for the members. So gearing to the hilt on a very high interest loan is possibly not within the investment strategy that's suitable for the members. So technically it can be done. I think it's also worth noting there are really, really strict rules around related parties lending money to the self-managed super fund. So again, when we think about borrowing, we typically go mainstream lenders that provide those products. Incidentally, it's generally not the big four banks because they
No.
don't do it, but there's sort of a pool of providers. But there are rules around not borrowing. Borrowing from related parties have to be on a commercial basis. So you have to prove that the terms that you're investing on or lending on, borrowing on, are the same as what you would achieve commercially. Otherwise, there's implications for non-arm's length income and expenses.
And then I was just going to mention as well, just on back to the mainstream sort of lenders that we use sort of thing, is that there's, generally speaking, there's a bit of a rate premium as well at Tratch. So it's not like you can compare apples to apples, like looking at like a typical home loan or even a commercial loan in some aspects as well. And the loan product itself is quite simple because of those restrictions you have in SMSF as well. So I mean, from a resi sort of side, it's probably just the offset. It's probably the only similarity. There's no redraw or anything like that as well. And the only thing I also wanted to mention as well, which, just to reiterate, is that once your loan amount is set, you can't sort of top that back up sort of thing. So it is quite important when you're looking at purchasing to make sure that your strategy is, well, I'm really trying to get X amount, whatever that may be, and making sure that coincides with your lending strategy as well. So
yeah, and it's sort of in some ways anti-intuitive that most of the time we would recommend people maximise their borrowing because they are unable to increase the loan limit later. If there's a desire to have a lower loan balance, we'd generally recommend we do that through an offset. So if we're aiming to have a net loan balance of $500,000, but we can borrow service up to $600,000, then we would do that $600,000 loan and then put $100,000 into offset, simply because we can access that money. If we don't do that, because of the illiquid nature of it, and we can't increase the loan, then the only way to get access to it is to sell the property. Yeah. So for most people, getting a loan more than what you possibly, what the strategy suggests is a bit counterintuitive. Yeah. But when you understand the restrictions on being able to access it later, it makes a bit more sense. Yeah,
and I think coming back to liquidity actually helps that you're using someone else's money, then that doesn't tie up so much of the fund's money. That helps on that sort of front, So I mean, all things considered, but
exactly. And if you're going through an environment where it might be fairly volatile, and you want to lean out of some other asset classes like bonds and shares and things, then effectively putting it into an offset, you're achieving a return equal to the interest rate on the loan. So, and guaranteed, because whilst it's in there, you're reducing the interest payable. So it's a good way of being, I guess, a bit more conservative or playing it safe when you're going through uncertain markets too.
Yeah, that's good. And the only thing I was just going to mention as well as when you refinance as well is that it can be a bit tricky to, with the transaction fees and things like that, to get it down to the actual dollar. So most lenders are quite good. You can actually request a lot more than that, to make sure that the settlement will go through smoothly sort of thing. But then at settlement date, they'll just adjust it down sort of thing to make sure that there is no redraw and you stay compliant. They don't want to be non-compliant either. So it is a bit of a smoother process for refinancing as well. There's no sort of this shortfall usually that comes up sort of thing if you've done it well. So
Gareth, I want to ask you, if someone is wanting to get into a self-managed super fund specifically for the purpose of investing in property, I know there's no hard and fast rule here, but generally as a guide, what would you recommend or suggest would be possibly a balance that they would need? I know this is a very typical question.
There's actually legally or within legislation no minimum balance. So, people say, you can't do it unless you've got 200, 500, whatever. At various times in history, there have been guidance papers where it's without this sort of level of fund balance, then you can't adequately diversify. So that's really been generally where those, and it justifies, the fees or costs involved spread over that sort of balance is where it's comfortably, you could say, it's going to put the other person in a better position. But there is no minimum. So it really comes down to the strategy. So depending on, what the individual members, who they are, etc., then the trustees could say, no, I think it's appropriate and we will set this up. I always sort of take the approach with clients that you want to have enough fund balance to get you into a market where you got confidence of growth. If you don't have confidence of growth or a strategy with confidence and yield from income from property, then why do it? You really need those results. And so to do that, primarily clients that we work with will look at capital cities. We won't look at regional areas because we don't have as much confidence that it's going to have the growth. And so you're then risking your future fund balance, your retirement balance. And if the property doesn't perform, then you've compromised on your retirement. So we generally want to get into a capital city where there is good prospects of growth. And then bearing in mind, as Simon said, how much you can borrow based on serviceability, and the price point you get into those markets, it's then about having on top of that enough to adequately diversify. So, for some advisors, that would be at least $100,000 invested into other asset classes in addition to cash in the bank for liquidity and the deposit for the property. That would still leave you as a fairly growth style portfolio, so would certainly not be appropriate for someone nearing retirement. So if you're a couple of years out from retirement, that sort of property strategy is probably not appropriate because of the time frame, costs of getting in and out of property. You're not going to see the growth to make it worthwhile. So for most people, that's at least 7 to 10 years of runway to make sure you've got the timing to actually get the results.
Certainly a lot to process there. I think we'll leave it at that today. Thank you again, Gareth. That's been exceptionally informative, and
great, thank you.
No doubt we'll have you back again soon.
Yeah, hope to be back again.
Please note, all the opinions and information in this podcast are of general nature only and should not be relied upon as advice. You should always seek professional guidance at all times before making any investment decisions. Please see the link at the bottom of each episode.